Hey, good morning.
Morning.
I'm recording.
Morning. Anders, would you like to chair remotely or how would you like to handle
I think
it?
it probably makes most sense to have someone, is my video off? Shouldn't be.
It's on. Oh, there it is.
Oh, there it is. Hey,
There it is.
yeah, I think it makes most sense for if someone in the room can manage the meeting. That probably makes most sense.
Any volunteers?
All right, I'll take it.
Don Harris was peer pressured into it.
Excellent.
First order of business is to, do the minutes from our April meeting, assuming everyone's had a chance to look at those, any suggested edits or changes? Vote for proof. Second, all in favor? Aye. Aye. So financial update, any, you want to, yeah, you could go, we could flip it, if you want.
I know, I need to be respectful of their time.
Yeah, let's do that.
You wanna?
Sure. Hi, everybody. It's good to see you. We appreciate your time this morning. So hopefully you had a chance to see the presentation. I believe Cassie is bringing it up right now. So I know that we have the economic piece in the back, which Bob is just going to talk about for a few minutes. And then I'll go ahead and talk about the results of the portfolio as of the end of June.
All right, thanks, Alicia. Good morning, everyone. As always, thanks for having us for so many years in a row. We appreciate that. I'm gonna try to make this high level, broad overview. Start with an observation, not particularly insightful, but despite the tariffs, the ongoing war in the Middle East, results of inflation, the economy and stock market have done pretty well. So the most important reasons trace back in one way or another to artificial intelligence. The data center build out has supported the economy. In fact, it accounts for more than 100% of corporate CapEx, meaning that if not for the data center build out, corporate CapEx would be negative. Also has propelled the earnings of the largest AI linked companies, the so-called hyperscalers. The other thing I would say in terms of the market doing so well, in the end, nothing matters more to stock prices than expected earnings growth. And thanks to this relatively small handful of mega cap AI names, expected earnings growth has been very strong, and that's allowed investors really to look past the war and inflation, and they can keep partying. Just for perspective, the 10 largest names in the S&P 500, mostly AI linked. Now nearly 40% of the S&P 500 value of the market value of the 500, and been responsible for a disproportionate amount of the earnings growth and the appreciation. And I would stop short of saying that the economy and the stock market are dependent on AI. But I will say that AI is playing a really important role in both the market and the economy. We don't know, this is a shocker, but we don't know when the music will stop. No sign that the party's gonna end soon, although it does appear that the intensity may be starting to fade. The Magnificent Seven, which we've heard so much about, recently underperformed. There's a growing grassroots resistance to the data centers. You know that, it's in the paper every day. And there's some logistical problems that are starting to pop up. So the expectations are very high, and it means, not surprisingly, that so too then are the odds of disappointment. Again, I want to just say it again, we don't believe that this, what's happening is going to come to an abrupt end. Our most likely scenario continues to be the cycle has further to go. However, and this is really important, however, the risk is elevated. It's elevated because the market is so concentrated. It's elevated because valuations are well above average. It's elevated because this AI build out has been so dominant in the picture. So it all adds up to potential volatility, and as you know, volatility is the very definition of risk. So as fiduciaries, we have been very careful in the way that we've managed your equity portfolio, and Alicia will have more to say about that, and if she hadn't planned to, now she is planning. Just a couple of quick words on interest rates. Not so long ago, probably the last time we met, inflation had come down to 2.5%, close to the Fed's target. The result, you can't remember when Powell made his first move, but I think the easing cycle had begun, it was about to begin. And the incoming Fed chair, Kevin, was assumed to be biased to ease rates. Now the picture's changed quite a bit. Inflation is in the mid 3% range, and the new Fed chair has demonstrated an unexpected independent streak. So the expectations now are that rates are probably headed up, not a lot, but headed higher. And that's a good thing for us because we have a lot of bonds. And with that, I would turn it over to Alicia, unless there's any questions. Hearing none.
Okay, terrific. So, I just wanted to quickly go through a few pages that we have here. So the first one really is just kind of the overall total picture. So you'll see the ending value of assets about 10.4 million. And just as a reminder, this does include assets held outside of Cerity. This includes roughly about $4 million that you guys have in restricted cash and money market. So about 10 million of it is outside of Cerity, with the other 6.4 that invested in the two accounts that we manage for you all. As you know, the reserve account, which is about 4.6 million, and the other account, the liquidity account, about 1.8. We're going to go into performance in the next couple of slides, but just bottom left, these are just the assets that we manage only, so it doesn't include the additional cash that you all have. So you'll see that predominantly fixed income, and then there's a sliver of the equities which resides in the reserve account. And to the bottom right, you'll see predominantly almost 70%, mostly US Treasury. So a very high quality conservative portfolio. The next page, this too is really just a summary page. So you'll see up top the 6.4. What I ask is actually if we can pass on this page, because we are going to go into further detail of the two portfolios, and this is just a combination of the two portfolios. So if we take a look at slide 4, so this is the reserve portfolio, as I mentioned, about 4.6 million. And this is the one, obviously, with the intention with that it is to be a reserve and not the liquidity, that we do have the sliver of equities. You'll see, it's a roughly around 8%. And to Bob's point about where we think we are in the market right now, given the investment policy statement, we do have liberty to go a little bit further up. Right now, we have a neutral stance when it comes to that. So we're right in the target, we're right where the benchmark is, and we're very comfortable with that positioning. And then also within the equities themselves, we have also a neutral positioning, meaning that we are, I think that right now that we are underweighting the Magnificent Seven, and we just recently added a value tilt, which we believe is prudent as we move forward. And actually, we'll talk about it in a second, but that has helped with the performance for the last year to date because the Magnificent Seven has been faltering a bit. But if we take a look top line, so you'll see, over listed, you've got the gross of fees, the net of fees. The first one, the HV, it's your historical benchmark. That's got the sliver of equities. And then the second benchmark noted in blue, that is just if you were to compare yourself against the bond fund, a short bond fund, about 1 to 3 years. So we wanted to go ahead and put all that data right there. So you'll see when you take a look at net of fees versus your benchmark, really in line with all the time periods, a quarter to date, even going down back through since inception. So when we look at the last 12 months, the portfolio of net of fee has returned about 4.5%, as where the benchmark was about 4.4. Again, very conservative portfolio. When you look at the asset allocation to the left, that really does just highlight the predominance of fixed income. And then over to the right, kind of drives that point home again, but that over 2/3 of this portfolio is US Treasuries. And I wanted to, we can flip to the next page, we can talk about more in the fixed income. So when we take a look at the next page, this is really, okay, how did our investments do by each of the asset classes? So you'll see on the top line that, on a gross basis, just how we did against your benchmark. But then when we take a look down at the different asset classes, whether it's cash, fixed income, US equities, non-US equities, really with cash and fixed income in line with the benchmark. US equities, that's where you'll see really, as I had mentioned, the outperformance that we've seen over the last 12 months. And that has been a result of our dialing down the Magnificent Seven, because we did want to dial down that risk. And then you'll see with the international equities, with the exception of the quarter, the year to date and the last 12 months, we have exceeded the benchmark. So we feel very comfortable with our equity positioning in the portfolio right now. Since it is predominantly a fixed income portfolio, we wanted to highlight the bottom left, just really, the high quality portfolio that we've got. So making sure certainly that we're in compliance with IPS, but that we wanted to make sure that we did have the high quality investments. And then over to the right, the fixed income distribution. This is really just showing you, by years, really what pieces of the portfolio are there. So you'll see the majority of them are under 5 years, which again is in line with what the IPS requires. And some additional points I wanted to make that aren't noted on the page, but the duration of the portfolio is at 2.4. So it has increased since the last time we met in January. The average coupon in the portfolio is about 3.5%, so higher than where we were at 12/31. And even when I do a historic look back, that is the highest average coupon rate that we've had, since for the past few years. And obviously that's a function of higher rates, which we didn't have, prior to 22. And so we're glad to see that coupon rate where it is. And that again, the rating, really falls on the upper, the high tranche of the high grade quality. So a conservative portfolio, but we're comfortable with the positioning as it stands right now. Now, any questions about the reserve portfolio before we talk about the liquidity portfolio? Okay, flipping to the next page, slide 6, liquidity portfolio, about 1.8 million. And as you know, that this is a shorter duration, we want to make sure that there's high liquidity for the needs that could come up. And when we take a look at the returns, and again, comparing it, we're using 2 benchmarks. We're using the US Treasury T-bills, which of course is a very short benchmark. And then we're also using secondary benchmark, which is the 1 to 3. So I think it's important to highlight those 2 differences. So you'll see when we take a look at performance with the net of fee compared to the benchmarks, you'll see really in line with the Treasury bills. Sometimes there's been slight underperformance, but when you compare it to the longer bond of the 1 to 3 year, you'll see that there's been outperformance in the majority of the time periods noted here on the page. This portfolio, the duration is shorter. It's about half a year. The average coupon is about 3.86. And again, the high quality. One thing I think to point out in both portfolios, you will see a higher than normal cash balance, we're required to keep 3%. But I know from talking with Andy and with the team that there was a possibility that there could have been some upcoming cash flow needs. So based upon what the resolution is with that, then if you need it, it's available for you. If you don't, then we're going to invest the additional cash accordingly. And we will take, I know when we came out of January, the idea was where we were gonna extend the maturity, certainly in the liquidity, or to extend the duration in the liquidity portfolio. So that is our long-term goal. So if we find out that we've got some cash that we can now invest, obviously yields have gone up since the beginning of the year. So there are some good opportunities out there. For instance, the 2-year yield right now is, I think, at about 4.2 right now, which would be a good opportunity to take advantage of that. So again, comfortable with the positioning of the portfolio. And just when you take a look at the last 12 months, so the portfolio net of fees has returned about 3.7%. And then this page really is just a further detail about how the portfolio did for asset class, very similar to what we saw with the reserve. And again, just couldn't really the breakdown of the ratings and the distribution. So you'll see the majority of it is under a year, with just a little piece over the year mark right now. And then the last page that I want to talk about, page 8, really, this reflects what's noted in your investment policy statement. We want to make sure that we're in compliance, and we are. So the top piece, of course, is just on the different investment accounts that you have. So all within the IPS ranges, and down on the bottom right, the fixed income detail, the key provisions that are again noted in your IPS, and making sure that we are abiding by all of them, and we are. So I know that that was high level, but certainly we wanted the opportunity to open it up for any questions.
Any questions?
Any recommendations as we move forward here?
I think Anders, once we get some clarity as far as knowing whether or not there will be cash needs that will be required, because what we have been doing is, as things have been they've been maturing, we've been keeping them in the money market. So again, with rates where they are right now, I think especially in liquidity, taking off the opportunity to continue to ladder out, but to go further out to, let's say, the 2-year, because that's an attractive spot on the curve right now. And as we know, as we've also seen as far as on the reserve account, the fact that corporate spreads have been extremely narrow, which of course means that investors are not getting paid to take on that additional risk. So being mindful that when those widen, to try to take some opportunity there. And of course, with the corporates, to be able to get an additional, let's say, 50, 60 bits on top of what the treasuries have.
So if it's okay, I'll just add something to Anders' question. Oftentimes, well, that question comes up every time, and it should. And usually it's a discussion of should we take more risk or more return, whether that's from the bonds or the equities. And right now, doesn't seem like an opportune time to do that. As Alicia just told us, credit spreads are narrow, and we're cautious about equity. So kind of across the board, it would not seem like a good time to take more risk. It is perhaps some of you have heard the expression risk on. It's a hyper risk on environment right now.
Only because you guys are here, do you feel like you have enough flexibility within our investment guidelines and to do your job?
Yep.
Yes, we do.
Mhm.
We do. And we would say the same thing if we weren't here.
No, and I know that Andy had reached out prior that you guys would be reviewing IPS, and we did not have any recommended changes. I know that, we made a lot of suggestions that were approved a couple of years ago, so we feel very comfortable with IPS.
It would seem that if we're only at 8% equities, that you have some latitude.
Yeah, I think we can go up to like 15%. So, and there have been times, let's say a year and a half ago, where maybe we were hovering at like 11%. So, right, but right now, just kind of given the risk in the market and that we're at kind of all-time, or close to all-time highs, that to be in a neutral positioning is where we feel most comfortable right now.
I believe the range is 0 to 25%. Or 0 to 30%. I shouldn't even open my mouth, but 8% is the midpoint, 7.5. So by definition, then, if you go to 15, 0 to 15.
Great segue question.
Right. Well, as always, we appreciate you guys coming in.
Well, we
We
really
appreciate it.
appreciate being here, and we appreciate the relationship we've had. For how many years has it been now?
2009, I think.
2009. That was a great year to start. It's all up.
That's your good night.
No, it's really nice to see you all, and thank you for having us. We really appreciate it. Thank you.
Thanks.
It's nice meeting
Thank you both. Thank you both.
So why don't we stay on topic and get the investment policy review? Be curious, Terry, have you had a chance to look at our investment policy guidelines?
Is that a question for me? I'm sorry.
Yeah, have you had a chance to look at our guidelines? Most
I have
curious
not,
if
no.
Okay,
I'll be happy to take a look at it, but I did not review it for today's meeting.
always curious what a fresh set of eyes might,
Sure.
bring to the table. I think it's, we've vetted it several times, since I've been here, and, I think, we've refined it. It's gotten better, I believe, in my, opinion, so, I don't know if anyone else in the room or on the phone has thoughts, ideas, any good idea? Should review it. Okay, it's a good idea. I like it.
I know we're conservative by definition, we have to be fiscally responsible for funds, but the comment that we're at an all-time high now is for about 8%, same 8%. Been at an all-time high for the last 3, 4, 5 years and missed a whole lot of opportunities in that time period because we were at an all-time high. So not judging or disparaging or anything, obviously that's a statement of time and risk. The all-time high comment.
I think that goes more to less about the guidelines, because I think the guidelines give us that flexibility to push the envelope a little bit, even. I one of the reasons why I've always encouraged them to give us that page 1 analysis is they're really talking about 15% equities in the money they're managing for us.
Right.
But in the scheme of things, we're really at 5% equities and overall, so we're really on the low side. If you look at the totality of our investments. Agreed. So I think, do we need a motion to approve the guidelines?
Typically, we would move ahead with a positive recommendation to the full board. I think
Okay.
maybe pending, council will come back at the board meeting with any.
Yeah, if Terry has any suggestions prior to the board meeting, take that under consideration and.
Guys, the question, John?
Yeah.
Before you take the vote on that, just a little history for me, if you would. When we had the exposure the last 2 years because of the lawsuit and I'm needing a lot more cash, all of a sudden if we lose that lawsuit, and now it's kind of behind us now. Does that change our philosophy about how to invest that money?
I don't think so, Rich, because I mean, we're still, accountable for the public authorities' accountability, and, we have policies that are in line with companies like us. And because of that, we have just an extremely conservative approach to how we manage this money. If we did more than this, we would be, I think, what I've been told, and maybe Terry has perspective on this, we'd be an outlier to our peer set of how we manage our liquidity.
That's fine. I
I'm
just know
told
anyway.
that we're one of the few, if any, companies, that public authorities that hold any equities
Yeah.
at all.
Yeah.
I would agree with that.
Got it. So SpaceX is out.
So we took a
Right.
big
And
position
so,
on the SpaceX IPO. Besides that, we were doing nothing.
okay. So can I get a motion to make a positive recommendation to the board?
So moved.
Second. All in favor?
Aye.
Great. All right, so then let's switch back to number 2, the financial update.
Sure. I was, as I was on vacation in absence for the preponderance of time, wishing if they're prepared, I'll be listening to thank the camera, my colleague, MB, for their assistance in compiling the second quarter materials. So, thank you. With that, I do have some prepared comments. Please feel free to stop me at any point in time, Tamara, especially about the step. I'd ask that the committee members turn their attention to the materials beginning on page 5 for a review of the narrative. Budget versus actual, P&L, balance sheet, and statement of cash flows. All these are for the period ending June 30, 2026. Financial results for the second quarter reflect strong performance from project and program activities, which more than offset weaker than budgeted operating results. On an overall basis, we reported a net income of approximately $432,000, compared with a budgeted loss of approximately $260,000. Resulting in a favorable variance of approximately $692,000. This positive result was almost entirely attributable to the activity associated with Clinton Market Collective, the receipts of the grant funding, Liberty Park, and other grant funded activities. Operating performance perspective, excluding project and program activity, operating revenues totaled approximately $134,000 or 18% below budget. Largest unfavorable variance was investment and earning income, because as the comment that Alicia and Bob made, we had been building the cash for a period of time. Now that there's a little more clarity as we progress throughout the year, they're able to pivot and deploy some of those excess funds. Real estate income also trailed budget by approximately $75,000, while general and economic community development support revenue exceeded budget by approximately $12,000, and professional service agreement revenue exceeded budget by approximately $39,000. Membership and event support, we're happy to report, finished modestly ahead of budget. Operating expenses before depreciation were generally in line with expectations, exceeding budget only by about $9,000. That represents our continued commitment to the solid conservative financial approach to managing the organization's resources. Personnel costs were approximately $96,000 below budget, reflecting staffing vacancies and timings of hires. These savings were largely offset by higher than budgeted professional fees and occupancy expenses. Professional fees exceeded budget by approximately $143,000, driven by consulting, legal, and project-related professional services. While occupancy costs were approximately $40,000 above budget. There's several exogenous activities, small in nature, but somewhat emergent that we have to address. Some landscaping issues and improvements to Clinton Market, and the installation of a more robust fence to secure the Liberty Park properties. After recording depreciation expense, operating activities produced a loss of approximately $437,000, compared with a budgeted operating loss of approximately $250,000. Program and project activity outperformed budget during the first half of the year, approximately $1.22 million, exceeding budget by $977,000, again attributable to the receipts of the Clinton Market Collective grant receipts and Liberty Park and 34 Hamilton project activity. Program expenses totaled approximately $354,000 to approximately $98,000 above budget. Again, as a reflection of project activity. Statement of financial position, as of June 30, we ended with total assets of approximately $25.2 million, essentially unchanged year over year. Cash equivalents, and investments remain strong at approximately $10.4 million, providing substantial liquidity for ongoing operations and strategic initiatives. Investment property continues to represent the corporation's largest asset at approximately $13.6 million. Total liabilities declined modestly to approximately 2.5 million, while deferred inflows also decreased from the prior year. Overall net position was approximately 21.4, reflecting our continued strong financial position despite significant investment in current projects. Cash flow from operating activities was essentially break even during the first 6 months. Capital activity included investment in property acquisitions and park improvements, partially offset by capital grant receipts and proceeds from property sales. Clarify that one. Investment activity generated positive cash flow through investment maturities and interest earnings, allowing cash flow and restricted cash balances to increase slightly to approximately 3.4 million a quarter. The overall assessment, the corporation remains in a strong financial position May through 26. The core operating revenues were below budget, primarily due to lower than anticipated investment earnings and real estate revenue. Disciplined expense management helped limit operating variances. More importantly, exceptional performance from project and program activities substantially exceeded the budget expectations and produced an overall positive financial result. Strong liquidity, stable net assets, and continued investment in strategic redevelopment initiatives position the corporation well for the remainder of 26. Have you taken any comments, questions, concerns? Mrs. Yes.
Oh, the disbursement,
With the father.
Yeah, so we received positive news this morning to add to this. We had recently submitted a request for reimbursement for Liberty Park funding. We've had some expenses in past years that we are playing a little bit of catch up on in terms of reimbursement. So we got our approval this morning to draw down just over $500,000 of those expenses. So getting there in terms of back to expenses.
That's great.
What are we, so of the property held for investment at least the 13.8 million, how much of that is Liberty Park? Liberty carrying Liberty Park?
Depends. I want to check the actual net value, but
That's what I saw, yeah.
Any questions? Andrews? You have any?
Nope. Looks good. I appreciate it. Good to have an uneventful finance meeting. That's exciting.
Operating costs for the work at the park at the next quarter, upcoming expenses.
Actually, I mean, we've been approved, we haven't approved anything, so we would capitalize those and apply those to the rate. So.
Building stabilization
Yeah.
expenses are forthcoming.
The material.
Yes.
We haven't heard, kind of background expenses.
What does the summer look like for the Clinton Market Collective?
There is a slate of programming through the Downtown Business Improvement District. Not just summer, but summer through the end of year is about 30 plus events. So Mondays are the Beats and Eats with the food vendor and DJ. There's live sport, movie series on some of the evenings. There's activation for First Friday. I think they plan the holiday market this year as well. And there's a number of not a significant number of vendors interested in renting the shipping containers, but there is about a handful of vendors interested in looking at the shipping containers for rentals, some of which are testing it out through short-term opportunities with the bid when the bid's activating it. So we'll see how that pans out in terms of full-time rental for those spaces. It'd be nice to have those open for lunchtime, Monday through Friday as well. But I think many of the vendors we've been talking to are a little bit more hesitant on the weekdays. They'd like to be there during the activations when there's the events being marketed in the draw, but a little bit more reserved on appetite for the weekday. So
Are
we'll
we
see how that pans out.
are we coordinating events with the Palace, like trying to get activation during when the Palace has a big night? All right. Are we
Yeah, I think that'll be.
Are we supporting the program with marketing dollars?
We have a contract with the Business Improvement District to pay for expenses affiliated with managing that contract. So they have been, purchasing, they've been working on some signage, and some marketing for that program. So that has been, that's starting now really in earnest. And then as far as working with the Palace, we'll be in, we'll keep up in communication with Kevin and the team about, additional events there and activation. I know they have their, back to school event coming up in August as well. So those are all good opportunities to help supplement that.
Back to school.
To
That's
expand on
all.
Nash's comment briefly, if you drive by, you'll notice some signage from the bid and, the kind of our renewed focus on site beautification. There was some sod installed earlier this spring, we're maintaining that. But you'll see some plantings, and just in general, we're trying to improve the site aesthetic. So, we hope that's recognized, at least visually.
Yeah, I think DGS was out there this morning, so getting some of the weeds.
The city won't be also promote events there, of course, to their websites and so forth.
Yeah, I think we'll have to make sure that they have, I did get them the full list of the tentative programming, but yeah, I think they will help coordinate, as much as possible in terms of getting the word out on that for sure. In terms of activation.
And we're definitely listed on the splash pad of our sites. So every time there's a promotion, there's always included on that roster. So we do get some visibility with the city.
You see how they attract visitors and guests and people to the events that have their use, of course. So it's building momentum, second, third year, and the goal to so. But no, it's gonna be there, like it's like a part of their routine as well.
We have noticed a lot of families making use of this stuff as just anecdotally on site for operations. Especially towards the end of the week, but in summer, we've seen both families tramp down the, towels and sandals in hand, and they're availing themselves of the site. So it's a community resource and not economic.
Right.
Well, it looks like we're in the other business portion of our meeting here. Just a real, you and I talked actually, in the state budget, they funded Restore New York again. So we would expect to see a Restore New York solicitation at some point this year. I would expect. I think we should be thinking about projects that we can pursue. That money can be used. It has to flow through a municipality, like we use for demo. At one point, Central Warehouses was a Restore New York project, but they pivoted at some point to these different funding source, but even that project in the South End that Chris Ellison brought up, our board meetings could be a candidate for something like that. So,
We've,
put our thinking caps on it.
yeah, so staff has started reviewing sort of that list of buildings, sites and buildings that would be applicable to that program. I do know some of the properties the city is in, that has in their ownership are in need of resources as well, like St. Joseph's Church. And potentially like the bathhouse in the South End. So we'll definitely be pursuing conversations with the mayor and her team about what makes sense in terms of priorities. So obviously have to have the end use ideally. So some of these properties struggle with having that entity that can take on development and operate it moving forward. Like, they need the preservation resources, but there's no one ready and willing to take them on yet. So that's some of the challenges that St. Joseph's has been facing, and the bathhouse in the second in this. So we'll take a look at those with the mayor.
Yeah, I'm thinking more of like Central Warehouse type projects that are just a bloody on the city that we could potentially take demo and if it came apart. Have a vacant building that's not in story.
Sure.
That list exists, John, somewhere. I know years ago, we told like 1,500 ago. There's more categories of why they just city hall, but a lot of them, like rectifier, doing demo, first prize, so they will touch them. So you know, is there a list of that?
I don't know.
A list of,
Buildings that are ripe for repurposing or demolishing for repurposing.
so we definitely manage like one internally, in terms of like what's applicable for like Restore New York and other grant resources. I'm trying to think what would be available publicly. EDC, the New York State Economic Developers Council, they have in the past used like State Book and other different private resources to be able to maintain that statewide picture of sites and
City
buildings.
wall. Yeah, the car got main drags and of course it have 3 or 4 or 5 buildings. That's so there's one. That's one. I kind of felt like we used to do them on a region on water scale, but a lot of them taking care of the it's the good news. They made nothing but they got there. Just curious.
Bath New York also has, I think the state's creating that list of the properties that are available through that program as well for big sites that they have. So there's a variety of different sort of lists out there.
Yeah. Well, that's just the gut, driving around to see properties, there's something. That's right before something else. So, you have to do an app or for that. There was that too.
I know.
Any other topics for other business? I wouldn't mind going into executive session to discuss the disposition of real estate. If that's,
The publicity of which would substantially affect the value. Yep. Okay.
Your motion, that,
Yeah.
Yes, sir.
so moved.
second. All in favor? Aye.
And it'll just take us a moment to move into a private breakout room.
So do we need to do the mo all over again?
Please.
Motion to.
Okay, three, thank you. A motion to come out of executive session.
Second.
All in favor? Aye. So let the minutes reflect, no action was taken in executive session. We did discuss the disposition of real estate. Any other business?
No.
Motion to adjourn?
Motion.
Second. Aye.
Thanks, all. That's great.